Hey everybody, welcome back to the Real Estate Rundown. In this episode, we've got Mark Willis. Mark Willis, say hi to everybody.
Hey everybody.
Perfect. He follows instructions, ladies and gentlemen. Hey, so Mark and I are going to be discussing real estate investing and self-banking and how an entrepreneur can fire their banker and become their own source of funding. So if you want to bank on yourself and how you might be able to do that in the best way, even more cash than you want, make major purchases, and grow your working capital fund. Well, you're going to want to stay tuned and see what we've got to offer here as we talk about self-banking, it being better than regular banking, traditional banking, and the amount of liquidity you can have for yourself to purchase more real estate in 2020 and beyond. So stay tuned. Follow us as we get into this new episode of the Real Estate Rundown with Shannon Robnett and Mark Willis. All right, guys, thanks for coming back. Hey, Mark, so I understand, Mark, you are an expert in self-financing whose accomplishments include the fact that not only you're a man on a mission who helps people think differently about their money, their economy, and their future, but after graduating college with a six-figure student loan debt, you discovered a way to turn your debt into real estate wealth. So I can't wait to figure that out and have you help us understand that. Mark, thanks again for coming on the Real Estate Rundown. Let's just jump right in and have you tell us a little bit more about your story.
Awesome. Yeah. We're in the midst of the end of 2020, and we've got murder hornets and presidential elections and a virus of some sort. But all I wanted to do all day long was just sit there and look at that beautiful beach behind you, man. So way to go. They're in beautiful PR. So it's all going to be okay now. So my name's Mark Willis. I'm a certified financial planner. We started our financial practice in the midst of the last Great Recession. I'll call it the less Great Recession because I don't know what we're going through right now, but it's not going to be anything that doesn't shadow 2008, in my opinion. We've got tens of millions of people unemployed and more bitterly divided government than we've ever had before. Now, with all the bad news, I think there's some real strategies and some things that haven't changed since 2020 began. I mean, there's been a lot of fundamental shifts in our world, culture, economy, the government. But one thing that hasn't changed is something that's existed since the dawn of civilization, Shannon, and that is banking. Banking exists. There's a great book out there by David Graeber. The book is called Debt, the First 5,000 Years. And that title says it all. I mean, So from the cave days, we've been trading and, working with banks or some proto version thereof. And banking exists today. And in fact, you and I and every other person listening, we are already in the banking business, whether we realize it or not. I feel like banking won't change no matter what happens with this virus, whatever. Banking will exist and continue. The question is, who is sitting behind the banker's desk? Right. That is the ultimate question. If you are behind the banker's desk, you're going to win. If another person or another entity is behind your banker's desk, they will win. Plain and simple.
Well, and it doesn't matter. You can take just about anything. You can take Dave Ramsey's philosophy about, pay everything off and set yourself free. And whether or not you believe that, the reality is that if you're paid off, you are your own boss. You're your own banker. You're able to be more mobile in this economy. Or you can go with Robert Kiyosaki's very fundamental book, right? Rich Dad, Poor Dad, where assets don't have the weight on you that liabilities do. Assets provide you with things, liabilities take things away. And the reality is all of that comes together in a very sensible way with banking and how financial freedom is tied to your ability to trade, to stop trading your time in a direct correlation with, hey, I was here for 40 hours, I got this much money. So how do you help people become self-financiers?
Well, you're exactly right. I think it starts with a question, Shannon. The best thing I can say to anyone listening is to ask yourself this very fundamental question: what do I want my money to do for me? Because if you don't ask that question, it's going to ask you to do things for it. So either you manage your money or it's going to manage you.
Right.
So take that 3 minutes or 3 hours and ask yourself, what do I truly want my money to do for me? And where your money lives will make it do different things. I'll say that again because it's so fundamental. It's so simple, but where your money lives makes it act different. And if you've got your money in the wrong environment, it's going to languish, it's going to die, and it might even cause you pain and suffering. A fish in the wrong environment is dead. You put a fish out of water, it's gone. But you put a fish in a nice temperature controlled aquarium with food every day, it's going to thrive, it's going to multiply, it's going to have little baby fishies floating around before you know it. So where do you want your money to live? I can't answer that for every person listening, but I can say that, where your money lives makes it act different. And for my wife and I, we had 6 figures of student loan debt. We had no plan to pay off the student loans. We had a massive monthly payment. I jokingly say I married 2 women in college. I married my beautiful wife, and I married Sally Mae. And Sally Mae wanted money every single month out of our pockets, Yeah. So we were following the Dave Ramsey method, which there's nothing wrong with being debt free, except I would say that there's something better than being debt free, and that's actually being the bank. That's certainly better to me than being debt free. When we were following that method, we stumbled across something called the bank on yourself concept, which I think is very relevant even to today's problems, struggles, hurdles that we're all facing today. I like to say that, as a certified financial planner, you really should be looking at all of your options. But Shannon, the trouble is there's 450, as far as I could count them anyway. So I was doing my studies, there's about 450 financial parking spots for your money. Real estate.
Doesn't surprise me.
Yeah. Mutual fund. Yeah. we could keep going. Annuities. Yeah. All of it. So what is it that we need our money to do for us? Here's a few key characteristics that I came up with. And Shannon, if you'd be willing, man, I'd love to kind of get just your own thoughts on this too. So I was thinking to myself, all right, we're in mega debt. We've got very little income. We need to figure out a place to put our limited resources. We wanted to build real wealth. We were watching the stock market crash around us. And I was working for a CPA at the time, watching all this happen. And so for me, I needed a few key characteristics for my cash. I wanted liquidity, so easy access to the money. I wanted guarantees that it was going to be there when I go to look for it, that money, right? I also wanted it to be growing in a predictable way. I wanted some sort of multiple tax advantages, like I didn't want it to be taxed every single year like a CD would be. And I didn't want it to be taxed in the future because I personally believed that my taxes would be going up over my lifetime. So I wanted tax-free access to the money. And also I wanted privacy. I wanted to be outside of creditor and lawsuit risk. If I was going to get into real estate, I knew, and I'm sure your audience already knows, that there's about a 9 in 10 chance that over a 10-year period, people in real estate get sued. It's just the way it goes. So that was my kind of short list.
I was going to say, if that's the short list, I'd hate to see the long one.
Yeah. Yeah. I really said, all right, everyone tells me to put money into a 401k, but where did that idea come from? This was a surprise to me, Shannon, but 401ks are not even old enough to get AARP. It's not even old enough to retire yet. Right. The 401k is 40 years old this year. Right. So what about you? Well, if you could just wave a magic wand.
The thing that I've always looked at is I get hit up all the time. People go, well, where do you find an accountant that can find all the tax savings? And where do you find a financial planner that knows everything? I say, you don't. You have to be, I have 5 or 6 people involved in my life, plus my own home study, right? So, I'm constantly reading books on new tax strategies. That's why I'm here in Puerto Rico. My accountant didn't know anything about that, and that's not her job, right? And so when I talk with people like yourself and I go, okay, what do you have to teach me? And when I hear that person go, well, this is the only thing you should be doing, I go, whoa, wrong teacher, right? But integrating all those strategies together where I've got tax advantages of a 401k, tax advantages of life insurance, tax advantages of all of real estate, of where you live, all those different things. And then you come up with a solution, a mix that will be a little bit different for everybody. But at the end of the day, Mark, you're exactly right that having liquidity is very important, especially if you're going to want to be involved in real estate, because so much of that is about timing.
Right. Well, that's so true. So combining items together can either make it more powerful or less powerful. If you
Right.
put nitro and glycerin together, you get something really wonderful there. Peanut butter and jelly, better together,
That's right.
So,
Right.
so I'd say find the right strategy, find the right financial products to combine them into the right financial strategy. Here's one that really stood out to me as I was needing and wanting to pay off my debt, build real wealth outside of Wall Street, and actually become my own banker. It was surprising to me when I found that whole life insurance, modernized whole life insurance, helped me do everything I just listed there. Access to capital. Life insurance is liquid, accessible cash. I can get the money out of my life insurance in about 4 or 5 business days.
Right.
Guarantees. It's built and grows guaranteed every single year. Doesn't matter who the president is, doesn't matter what the stock market's doing, doesn't matter who's sneezing on who. It's going to grow guaranteed every single year. It's tax-free when I access the money. If I've designed the policy correctly, it's like a Roth IRA, except without all the restrictions of a Roth IRA.
Right.
I can put in whatever I want into a policy. I can contribute to that policy. I can access it without any government restrictions. I don't have to wait till I'm 59 and a half years old, like a Roth IRA would make you wait. And of course it is life insurance. So it's going to leave an instant estate for my family and pay off estate taxes if those come back and that sort of thing. So that's sort of been my key, my parking spot, you might say, my garage for all my cash, but I certainly don't leave it there. And to your point, Shannon, what I do typically now that I've built these kind of a portfolio of what we call bank on yourself designed whole life policies, what we do is we use the cash in those policies to become our own source of financing. And maybe that's a little bit about what we can talk about for your audience today, especially as it relates to real estate.
Well, and that's so true. One of the things that I've always told everybody that will take the time to listen is I can show you ways that you can do 30% more with what you're already making, right? And that's just limiting your uncle, right? That's getting rid of Uncle Sam, identifying who he is, identifying strategies to not let him have 35 cents out of every single dollar that you bring home. And you don't have to do that forever, because if you can go 35% farther without him, then that's great. So let me just ask you straightforward, how can I use what you're talking about in a tax advantaged way to make it go 35% farther or 20%?
Yeah. Well, and I'll even tell you a pretty interesting strategy we've used to even maximize what you still have to pay in taxes to build wealth off that too. So we'll get you from 100 to 35, to 75%, 65%, but then we'll figure out a way to build real wealth on the check you still had to write to the IRS every year. Because like a lot of our business owners, they're still struggling. Their PPP money's run out, their EIDLs run out, and they need cash. Cash is what operates most businesses, every business. It's like oxygen, and they all pay taxes. And you're right. I think the general notion is that taxes are going to go up in the future. So the big question is, do I want to pay tax on my seed or my harvest? Do I want to pay tax on the seed or the harvest? And one thing is for sure, the harvest is great. The seed is usually small. So the question is, all right, what does my harvest look like? Do I want to pay taxes on a harvest that I'm not sure, the government's going to take or keep? It's sort of like, we're coming up on Halloween here, and we're going to take my daughter out for trick-or-treating for one of the first times ever for her. She's a little 4-year-old. But I was thinking back to when I was a kid, and I was the nerd in the neighborhood, and there were a couple of bullies that approached me one year, and they said they were going to take my candy when I got back from all the trick-or-treating. So right there, Shannon, how motivated would you be, if you were me, to collect a ton of candy?
Right.
Okay.
Exactly.
Now you see where I'm going here. So Congress hasn't quite voted on exactly how much of my 401k, if I had one, how much of our 401ks they own.
Right.
They haven't voted on it yet. Yeah,
they'll get to it. Trust me. They know it's there, but there's other people they're shaking down for candy right now.
That's right. That's right. Yeah, and they get to vote every year throughout your retirement exactly how much they own of your 401k. There's no. This is not a tinfoil hat theory. This is exactly how the 401k was written into the tax code.
Right.
So I'd say, take a look first at what your overall tax strategy is to lower that tax bill this year. And that's what a good CPA can help you do. but also how can we lower your tax bill and obligation, not just this year, but over the rest of your lifetime and even into future generations. I want to see how little we can still pay our fair share, of course, but how little we can pay to the IRS over the next 3 generations. That would be a really cool tax strategy to talk about.
And the funny thing is too, it's funny that you feel the need to mention pay our fair share. And it really, to me, the reason that that's humorous to me is it's because how you interpret the tax code, right?
Fair. Yeah, right. Mm-hmm.
But if you interpret the tax code as a penal code, if you don't do this, if you don't have rentals and you don't have depreciation, then you will pay this tax. Or you interpret the tax code as the incentive code that says if you have rentals, then you will have depreciation and you won't pay this. So the reality is everybody, depending on which side you're on, if you're taking massive tax advantages, which are yours to have because you understood the code, then you've interpreted it as an instruction book, not a penal code, right?
Well said. Well said. Couldn't have said it better myself. Yeah.
I've always encouraged people to understand what it is that gets you the biggest discounts, right?
Right. Mm-hmm.
I mean, I'll tell you a little guilty habit I have. I own a couple of airplanes. And I like to buy the airplanes at the end of my tax year and put them into a company called Phoenix Aviation that rents out airplanes. And then I depreciate the airplane in the year that I bought it in. And my wife can't even argue about whether or not I saved money buying an airplane. Right?
Yep.
But it's because I understood the tax code that I understood that that was available to me. Right? So I figured out a way to make a business out of an airplane because I wanted to do exactly the kind of thing that you're talking about, is minimize my tax code. But now that I have what's left, I have to pay that tax on it. So how can I do what you're suggesting with the seed that I have left after I bought the airplane? Don't take away my airplane, Mark.
Yeah.
Right. So, but I already got the airplane. So now what?
Sure.
What is your concept that allows people to move on from there, that grows it for 3 generations?
Well, yeah, you're exactly right. The tax code is a series of incentives. It's an instruction book. We are helping guide the nation to doing what we need. We, meaning the people, we the people, need our country to have. The government doesn't want to be in the real estate business, so they invite private investors like yourself to invest in local economies, and they reward you for the trouble. That's what we call a tax advantage there. I mean, we could talk about other fun ones as well, like employing your children, doing the business 199A deductions,
Yeah, but that's just
vehicle,
awkward when you got to write them up and fire them. You know, I mean,
put them in the airplane. They can serve you drinks or whatever.
Yeah, exactly.
But so one of the things that we've really found to be quite helpful is lifetime tax strategy. So life insurance, speaking of tax advantages, has always, meaning since 1913, the IRS is only 107 years old right now. And life insurance predates the IRS by a century. So using a grandfathered tool like life insurance, putting money in after tax, and then letting it grow tax deferred and have access to it completely tax free allows us to use that money. The harvest is all tax free cash under current tax law, and as it's always been. And the death benefit is income tax free. So if I'm putting in $100,000 a year or $300,000 a year or $3,000 a year, add a zero, take away a zero, I can pump money, any amount of money I comfortably want to, into a whole life policy designed this way that we've been describing. And that money for the rest of my life is never exposed to the taxes ever again. And that money, taxes can double, taxes could triple, but that money in that whole life policy is accessible to me over and over again without any taxes due, no matter what taxes due. So if taxes double, 0 times anything is still 0. So I like that for my tax law. And of course, I can pull that money out. I can invest in real estate, take advantage of all the tax advantages that real estate affords, recycle it back into my policy. And while that loan against my policy is outstanding, Shannon, if it's designed correctly, the policy will continue to pay me growth and dividends on the entire cash value as if I had never taken out a loan. So let's say I've got, pick a number, let's say I've got $500,000 in cash value. And let's say I want to invest in one of your deals, or maybe I want to invest in some real estate. Let's say I borrow out $400,000 to go do something. My policy that year will still pay me a full guaranteed cash accumulation and a dividend on the entire 500 grand, even the amount I had borrowed out to give you or invest anywhere else. That to me is an incredible arbitrage. And all of that was after tax, and all of that was tax-free. And of course, I get to take advantage of all the regular real estate advantages that the tax law affords us. Now, once it comes out of my policy in retirement, whatever that word will mean for each of your audience members, that's also income tax free. So I'm sucking all the money that I've pumped into that policy over however many years, whether 1 or 10 or 30, it's all coming back to me tax free. That's awesome. And I pass away and I leave the death benefit income tax free. So show me anything else that can do that kind of multiple use case. It's almost like a Swiss Army knife in the tax code.
Well, and the other thing too that we have been doing a lot lately is doing a cost segregation study to do accelerated depreciation, right?
Yeah.
So if you look at that scenario, and I challenged a doctor friend of mine who's one of my business partners, and doctors are really smart people. I'm not saying they're not. But there's certain concepts that are difficult for them to grasp. And this was one that I was telling him because every month he was putting away his anticipated tax payment that he was going to have to pay. And at this time, he had about $200,000 in his bank account waiting for the day that he was going to pay taxes. And I said, you know what, Doc, you need to buy a $800,000 asset. We'll depreciate it out. You'll use your $200,000 for your down payment, and you will be able to get your tax bill wiped out. And he said, you're crazy. I said, no. I said, let's get your accountant on the phone. We got the accountant on the phone. We ran through the basic numbers, and that was happening. Then the accountant says, I think maybe he was one of your students. He says, but if you put it in a life insurance policy first, then loan it to yourself, so now you're three-stepping it. So the reality is, Mark, you can sit there with putting it into a whole life policy. You put in your $200,000. Mm-hmm. You're borrowing out a portion of that. You're using that as your down payment to buy the real estate that gives you the depreciation that lowers your tax bill by the amount that you put in your life insurance policy.
It's great. It's a tremendous strategy. I love it.
Now, The fact that I borrowed this and put this into my real estate, what happens when I sell my real estate and make a profit on that?
Mm-hmm.
Do I have to pay back the loan?
Well, you don't have to pay back the loan. In your lifetime, the loan could be left outstanding, and then you pass away decades from now. The death benefit is simply reduced by whatever the loan balance is. Most of our clients recycle the money back through the policy and then borrow it out again for the next deal or whatnot.
Yeah. So what are there tax advantages to this if we do this inside of a business?
Mm-hmm. Yeah, there's a couple of really cool strategies inside the business. Let me give you just a few. It can be a tax-deductible premium. So most people aren't aware that you can do bank on yourself inside a business, deduct premiums that you're putting into the policy. And then the policy is accessible income tax-free for the owner when it comes time for he or she to retire. Now, most people aren't even aware you can do that, but it is possible depending on how you're incorporated and all the details of your business. But you can deduct premiums, meaning your contributions into the life insurance. And again, just like you said, you can put, any amount of money. You brought up $200,000. You could put any number into a policy as long as the underwriters at the insurance company can approve you for it. And there's some strategies for using it for tax deductibility of the payroll expense or the deductibility of the premiums, that is. But you can also use it inside the business for your business's acquisitions. Guys, your business needs capital. So, if you've got a decision to make, hey, do I want to pay cash for that new boiler that we need for the building, or am I going to use my life insurance policy? Let's think about it for a minute. If I pay cash for the boiler, $100,000 or whatever it's going to cost me, that's $100,000 I'll never see work for me or earn for me ever again. Right. If I use my life insurance policy, I get to use, I'm still a cash buyer in the eyes of the boiler purchase seller, but for me, I'm borrowed from my life insurance, and that policy, the life insurance cash value, continues to earn as if I never took the loan. And then I let renters or tax refunds or whatever else I want, windfalls from selling a piece of real estate, pay off the policy loan. So I just wash, rinse, repeat, and continue the upward cycle of using this policy as a line of credit to myself, guaranteed.
I've also heard, Mark, that business owners use this as employee incentives, or what do they call it? The golden handcuffs.
Yeah. Mm-hmm.
How does that work?
Yeah, you can use it as a golden handcuff strategy. I love the strategy. I'll use golden parachute and golden handcuffs.
Whichever,
So, yeah, both of them. Yeah. For the owner, it's a golden parachute, because
Right.
you've built for yourself an asset on the balance sheet of your business that you can use as a line of credit for your business. Had a gentleman who had $1 million line of credit at the regular bank down the street. It was in, a couple years ago, and he had his line of credit slashed in the midst of the last recession. They termed out his loan from $1 million down to zero. Pay us back in 5 years. We're out of your business. And that was a great time to get out of business with, in the midst of the last recession. So this guy was like, I am firing my banker. I am sick and tired of these banks. So what he did was over 5 years, packed as much as he could into a policy, had a $1 million line of credit that he uses inside his policy to operate his business. And, he's used that as his personal retirement plan, a golden parachute. So he can use that, walk away from his business, sell his business, walk away with his $1 million cash value of his life insurance as another tax-free income retirement stream for him. So that's the golden parachute. A lot of people also want to retain good sales guys or gals or other important key people in your business. And maybe you want to give them a sort of a bonus, but you don't like the idea of having to get stuck with just a 401k, or maybe you want to give something on top of your 401k to your best employees. You can pick the best 2 or 3 guys or gals in the business. On top of their 401k, you can give them an executive bonus life insurance policy. These are very common in upper boardrooms and executives. If you look up the 162A plan on the tax code, it's a great way for you to deduct contributions on your tax bill. So the business gets to deduct the premiums, and the executives or the key people, it could just be a great sales gal or it could be just an important person in your business. You want to give them that bonus, that extra, it could be $3,000 a year, it could be $300,000 a year that you give them as a bonus, and you get to write that money off as a payroll deductible expense. Just some ideas there for payroll.
So let's dig into that for a minute, okay? Let's say that I want to give an employee a $25,000 bonus this year. I give that to them. They're going to walk home with maybe 12 grand of that by the time Uncle Sam gets done saying, well, that was bonus, that was additional compensation. We're going to get our grubby little hands on it. But if I put that into a policy like you're talking about, and this person and I work together for the next 10 years, then they haven't gotten hammered on it, because this is the thing. If you're looking to bank on yourself, you're not looking to increase your lifestyle with the 25 grand. You like to do things with it that are tax deferred. So if you were able to do that for 10 years, in 10 years, you're going to leave my employment with $250,000 that's cash value to you.
Mm-hmm.
Now, can I use that during the 10 years as far as my business goes, or is that entirely yours?
Oh, it's a creative solution. And the answer is both. You can choose as the business owner. Yeah.
That's what I'm talking about. I love you because you loaned me my money back.
Shannon, yeah, you get the right.
That sounds like that sounds a little tacky, but I still love you because
thank you. I appreciate it. I appreciate that. So I'll let my wife know, but I'm sure she'll be glad to. So, so no, the quick answer is you're the business owner. You get to decide. You're in control. If you want to own the asset while your employee is working for you, it's your asset. And then if he or she leaves, you can offer that to them as a parting gift. You can put a vesting schedule on that. That's up to you. It's not a government sponsored ERISA retirement plan. So there's no locked in vesting schedules, and you can decide to make that a 3-year thing or a 10-year thing or whatever you choose. You're the business owner, and you can use the cash while they're still working for you as another bucket of money for your capital expenses, whatever your business needs.
Do I have to do the same thing for each employee?
No, you could pick the janitor and the best sales guy, and then that's it. You can choose any combination
So
of employees.
it's not like a retirement plan where I have to do, if
No.
if I do a simple IRA or something like that, I have to do the same thing for everybody.
Right.
And
Yeah.
then when I go to put money in, $25,000 from an employer's standpoint doesn't fit to go into that retirement account.
Correct. Yeah.
And that's their retirement account. I can't ever have access to it again.
Mm-hmm. That's right. Yeah. Yeah. So given all this, the business has their needs, the employee has theirs. So you want to build a real good relationship with your employees. Most business owners that I work with, we do both. We have a bonus pot that they get if they stick with you for 10 years, let's say, and you give them something that they can enjoy, see growing, have access to every year, for example, and you can deduct that. So part of our conversations we have with clients over Zoom or over the phone is we just figure out what's the situation here with your business? Who are your employees? Who do we need to build a real package for to help retain them or attract them? That's really what we focus on.
So if we're doing this in an employee scenario, can the employee contribute also?
Yes. Mm-hmm. Yeah, so, we have a combination deal where if you put in some, they put in some, matching program. Mm-hmm.
Yeah. So this really gives you a lot of flexibility. Now, if I'm looking at it from a business owner standpoint, the reason that I do a simple IRA is because I want to get money out of my company to my employees, to myself for retirement. But I'm 48 years old. I can't touch it for another 11 years at a minimum, right? Mm-hmm. I can't borrow it back. I can put it into self-directed IRA stuff, but even then, I can't be the
can't fill your airplane with gasoline, with fuel with that, right? Yeah.
Right. And I can't decide not to pay it back, right? It has to go into a hard asset, and it has to go back the minute it's out of that hard asset.
Right.
So basically, you've just told me that not only can I be my own banker, I don't need a IRA guy either.
Yeah. Every company is going to have their own decisions. I have found that SEPs, simples, they're like blunt instruments. They're like combo meals at McDonald's. They're fine for some people, but I would say if you're really looking for the ribeye, if you're really looking for a great like custom tailored solution for your business, you can do more, and you're able to have both. You can have the regular SEP for the average employee, and for those special individuals that you really want to keep, you can attract them or retain them with these additional packages. And for you as the business owner, it gives you more leverage.
So what if we got partners, right? So what if I'm not the only owner of a business? Is there a way that we can protect each other as well as do the same thing?
Yeah. Again, being a bank to your own business affords you some pretty cool competitive edge against other guys or gals in your niche. So think of the average business owner who desperately needed cash earlier this year and is going to need more cash now. They're going to be begging a bank or hoping and praying for stimulus checks, whatever. But you, with your savvy business partners, created a asset on the balance sheet of your business that's liquid and protected and market resilient and guaranteed to grow and always available to you, no matter what the markets, no matter what's going on with stimulus checks or cash available to your business. So you've got a line of credit to your business. It just so happens it's life insurance. We could be talking about anything. We could be talking about any other asset, but it happens to be life insurance. So Shannon, if you and I are in business together, and let's say you don't, let's say that I pass away one afternoon and I don't show up at work the next day. Instead, my wife shows up and she says, "Hey, Shannon, now I'm 50% owner of our business." And you're like, "Wait a minute, do you know how to run this business?" And then she says, no, of course not. I just decided I'm going to run this thing. And now you're in trouble because you've got an equity owner you didn't really want to have. Right. So life insurance.
I'm sure she's a nice lady.
Yeah, she is. She'd be a better partner than I would. But
other than picking you, I don't think she's made too many choices, right? I mean, that's a story my wife gets all the time,
right? Right. Yeah.
So other than that one bad choice, what else have you done right?
That's great. I love it. I'm going to use that. That's all. So she would definitely be a better partner. But let's say for whatever reason you weren't interested. What you'd have in the life insurance death benefit from my passing is a giant pile of money where you could pay her off, and you'd even have a written agreement saying that she would take that cash. And so she'd be happy with a bunch of money. You'd have all the equity, and all of a sudden you've got equity ownership, and you can do with it what you will. That's a buy-sell agreement where you can walk away if that should happen. There always needs to be an exit strategy for a business. Yeah. Heck, there needs to be a business exit strategy for just about everything in our life. But with a business especially, we need exit strategies, and a buy-sell agreement, a great strategy using life insurance, can make sure that you've got a walk-away plan if something should happen.
Well, and the other thing that it does too, Mark, is it puts away for a rainy day. I mean, you keep saying it shows on your balance sheet, and I don't know that my listeners totally understand, but if you're in the bank asking for money and they go, well, what's this $500,000 right here? Well, that's my life insurance policy. That's the cash value inside that. And they go, well, $1 million life insurance policy isn't too great, but a $500,000 cash value is tremendous.
Right.
So, Mark, I know that when I look at where my life has taken me, if I were to have set this up when I was 25, I would have outgrown it. How do I get this right? Is it a one size fits all, or can I get multiple policies, or what happens here when I start with you and I go, I think $1 million is going to work, or I say, I don't care about the insurance, I just want to grow the money. What do we do?
Yeah, everybody I sit down with, we have a 15-minute call. That's just quick answer questions. Happy to do that with your audience today. And then after that, we'd have a more in-depth meeting to listen to your objectives, your goals. It's not a good fit for everyone. Guys, don't do this if you're just looking for 30% rate of return every year, or if you can't save money. This is not a good strategy for folks unless they can save or have cash to set aside. But to answer your question, my first two policies, my wife and I started each at $500 a month. That's all we did. That's all we could do at the time. But it was something in our 20s to get started. And since then, we outgrew those. So we just bought more policies. You can add as many of these as you can be approved for. And now we've got 10 of them between multiple different companies. And each one, is a different size and different limit. And so maybe your policies are going to be different, Shannon, today than they would have been at age 25. But the point is, you've got the control, the ability to make your own design and custom tailor it to what you're trying to accomplish.
So but there's a cost to the insurance, right?
Yes, definitely. Mm-hmm.
So the fact that I have 10 policies, is that like having, when you get in a taxi, the first mile is the most expensive, right? Yeah. Is it that way with insurance, or does the fact that I have 10 policies that are each $1 million all equate to roughly the same cost as one $10 million policy?
Well, I'd say it's going to be 6 one, half dozen the other in that question, the way you phrased it. But, let's use that idea of the metaphor. The metaphor of the taxi is interesting. Let me use the metaphor of an airplane. So that first mile of your airplane is the least efficient, right? That least efficient mile is the first mile. But every single mile, a taxi doesn't get more efficient every mile it drives, but an airplane gets more efficient every mile it flies. There's less fuel in the tank, and it's actually overcoming inertia. And it's going, at a more efficient mile every mile it flies. The same is true with the life insurance. Give you a quick example. Usually these policies, I start the first 2 or 3 years, there's some insurance expenses. And again, guys, don't do this if you can't get past the first 2 or 3 years of insurance expenses. We're talking, if you put in $100,000, you might have anywhere between $60,000 and $85,000 of cash value in the first year. So somewhere in that ballpark. So we're buying life insurance in the first 2 or 3 years. But by the year 3rd or 4th, now the policy is growing faster than we can contribute to it. And so at that point, again, the airplane, it's getting more and more and more efficient. And in fact, by year 10, 20, 30, whatever, now it's like unbelievably accelerating, where the policy is actually increasing double, triple, 4 times your annual contributions. And so it's sort of a long-term financial strategy. Did that answer your question, Shannon?
Yeah, it does. So, Mark, what I'm hearing you say is that this is something that does a lot if used properly. However, used improperly leaves you with nothing but a bad taste in your mouth for insurance, right? So when you talk to the guy whose brother's sister's cousin did this one time, probably not the right guy to talk to, right?
Yeah.
But the reality is, Mark, I want to say thanks for coming on the show. I want to say thanks for taking the time to explain this to our listeners. And, everybody, thanks for tuning in. Thanks for being with us this week. I want you to go check this episode out. I want you to get a hold of Mark. His information is in the contact, so you're going to be able to get a hold of Mark at
NotYourAverageFinancialPodcast.com. We made it nice and short for folks. NotYourAverageFinancialPodcast.com. Click on request a meeting. Happy to chat with folks
there
for
you
15 minutes.
But hopefully you guys enjoyed this episode where you can learn to be a real estate investor and a self-banker at the same time, and how an entrepreneur can fire his banker and become your own source of financing. So guys, share this episode with your friends. Use the social media buttons at the bottom to comment, like, subscribe. And thanks again, guys, for tuning into the Real Estate Rundown. And thank you very much, Mark Willis, for joining us.
My pleasure.